Real estate is a lot like life. Timing is everything. Just like in life where the right moment can make all the difference, in real estate, knowing when to act can significantly impact your success. Whether you're buying your first home, investing in rental properties, or selling a commercial space, the timing of your decisions can be the key to maximizing your returns. Buy low, sell high, right? This age-old adage is the cornerstone of successful investing. But how do you know when the market is at its lowest or highest? It's not just about luck. It's about understanding the market dynamics and trends that influence property values. Sounds simple, but knowing when to make your move can feel like a guessing game. The real estate market is influenced by a myriad of factors, from economic indicators to seasonal trends and even geopolitical events. It can be overwhelming to keep track of all these variables, but with the right knowledge and tools, you can navigate this complex landscape with confidence. That's where understanding real estate market timing comes in. By studying market cycles and trends, you can identify the optimal times to buy or sell properties. This knowledge allows you to make informed decisions rather than relying on gut feelings or hearsay. It's your secret weapon to making smart investment choices. Imagine having the ability to foresee market shifts and position yourself advantageously. This strategic approach can help you avoid common pitfalls and capitalize on opportunities that others might miss. Think of it like this: you wouldn't buy a swimsuit in winter, would you? Just as certain products are seasonal, so too is real estate. Different times of the year can offer varying advantages for buyers and sellers. For instance, the spring and summer months often see a surge in property listings and buyer activity, while the winter months might present fewer options but also less competition. The same goes for real estate. Understanding these seasonal patterns can help you plan your moves more effectively. If you're a buyer, you might find better deals during the off-peak seasons. If you're a seller, listing your property during peak times can attract more potential buyers and possibly higher offers. Timing your purchases and sales with the market's rhythm can be the difference between a steal and a struggle. By aligning your actions with market trends, you can optimize your investment strategy and achieve better outcomes. This approach requires patience and diligence, but the rewards can be substantial. Now, I'm not talking about predicting the future. Real estate markets can be unpredictable, and no one can foresee every twist and turn. However, by staying informed and adaptable, you can make educated guesses that increase your chances of success. Nobody has a crystal ball, but you don't need one. What you need is a solid understanding of market fundamentals and the ability to interpret data and trends. This analytical approach can help you make decisions based on evidence rather than speculation. But by understanding market cycles, you can make educated decisions that set you up for success. Market cycles are patterns that repeat over time, influenced by economic conditions, interest rates, and other factors. By recognizing these cycles, you can anticipate changes and adjust your strategy accordingly. Whether you're a seasoned investor or just starting out, knowing when to jump in and when to sit tight is crucial. This knowledge can help you avoid costly mistakes and seize opportunities that align with your investment goals. It's about being proactive rather than reactive. It's all about maximizing your returns and minimizing your risks. By timing your investments wisely, you can enhance your profitability and reduce the likelihood of losses. This strategic approach can lead to long-term success and financial stability. So let's dive in and unlock the secrets of real estate market timing together. With the right knowledge and tools, you can navigate the real estate market with confidence and achieve your investment goals. Let's explore the strategies and insights that can help you make the most of your real estate ventures. The real estate market is a bit like a roller coaster. It's thrilling, unpredictable, and can be both exhilarating and terrifying at the same time. Just like a roller coaster, the market has its highs and lows, and understanding these fluctuations is crucial for anyone looking to invest or make informed decisions in real estate. It has its ups and downs, twists and turns. These movements are not random. They follow a pattern that can be studied and anticipated. By recognizing these patterns, you can better prepare yourself for the ride. These ups and downs are called market cycles. Market cycles are the recurring phases of growth and decline that the real estate market goes through over time. They are influenced by various factors, such as economic conditions, interest rates, and consumer confidence. Just like you wouldn't hop on a roller coaster blindfolded, you don't want to navigate the real estate market without understanding its cycles. Knowledge of these cycles can help you make strategic decisions, whether you are buying, selling, or investing in property. There are four main phases in a real estate cycle: recovery, expansion, hypersupply, and recession. Each phase represents a different stage in the market's journey and has distinct characteristics that can impact your strategy. Each phase has its own unique characteristics, and knowing where you are in the cycle can help you make informed decisions. For instance, during the recovery phase, property prices may be lower, presenting opportunities for savvy investors to buy at a discount. Think of it like this: recovery is like strapping yourself into the roller coaster. The market is just starting to pick up after a downturn, and there is a sense of cautious optimism. Investors begin to see potential, and the market slowly starts to gain momentum. Expansion is the slow climb up the hill. During this phase, the market experiences steady growth. Property values increase, demand rises, and new developments are common. It's a period of confidence and optimism. Hypersupply is the peak, where the excitement is at its highest. The market is booming, and there is an abundance of properties available. However, this phase can also be a warning sign that the market is becoming overheated, and a downturn may be imminent. And recession is the drop, where things slow down. Property values decline, demand decreases, and the market contracts. This phase can be challenging, but it also presents opportunities for those who are prepared and can navigate the downturn effectively. By understanding these phases and their indicators, you can anticipate market shifts and position yourself for success. For example, keeping an eye on economic indicators, such as employment rates and interest rates, can give you clues about where the market is heading. It's all about riding the roller coaster smoothly and coming out on top. With the right knowledge and strategy, you can make the most of each phase of the market cycle, turning potential challenges into opportunities and ensuring a successful real estate journey. Recovery. It's a breath of fresh air after a market downturn. The feeling of renewal and hope is palpable as neighborhoods start to come alive again. Streets that were once quiet and desolate begin to buzz with activity, and the air is filled with the sounds of construction and renovation. This phase is like the calm before the storm, where the market starts to show signs of life again. The early morning light symbolizes new beginnings, and just like the city waking up, the real estate market begins to stir from its slumber. But how do you know if the market is truly recovering or just taking a breather? It's a critical question for investors and home buyers alike. Analyzing market data becomes essential, as it provides the clues needed to make informed decisions. Look for these telltale signs. Property prices start to stabilize, maybe even inching upwards. Foreclosures slow down, indicating that fewer homeowners are in distress. This is a positive sign that the market is finding its footing, and buyers start dipping their toes back into the market. Open houses see more foot traffic, and potential buyers are more willing to make offers. This renewed interest is a strong indicator of a market on the mend. Construction might pick up as developers sense opportunity. New projects break ground and cranes dot the skyline, signaling confidence in future growth. This uptick in construction activity is a clear sign that the market is gearing up for a rebound. This phase is all about cautious optimism. Investors are hopeful but remain vigilant, carefully watching market trends and data. They know that while the signs are promising, it's important to stay grounded and not get carried away by the initial positive indicators. It's a great time for savvy investors to snag deals before the market heats up. Those who can identify undervalued properties and act quickly stand to benefit the most. It's a period of strategic buying where patience and research pay off. Think of it as finding a hidden gem before everyone else catches on. The thrill of discovering a property with great potential at a bargain price is unmatched. It's like being a treasure hunter, sifting through the market to find that one perfect deal. Remember, recovery can be a bit unpredictable. Just like nature, the market has its own rhythms and cycles. There will be ups and downs, and it's important to stay adaptable and ready to pivot as needed. It's like a seedling pushing through the ground. You know it's there, but you're not sure how strong it'll grow. The initial signs of growth are encouraging, but it's crucial to nurture and monitor the market closely to ensure it continues to thrive. Keep your eyes peeled for the signs, and you'll be ready to capitalize on the upswing. Stay informed, stay vigilant, and be prepared to act when the time is right. The seeds of a rebound are there, waiting to be cultivated into a flourishing market. Section 4. Expansion. Riding the wave of growth. Expansion. This is where the real estate roller coaster starts to climb. The market is gaining momentum, and things are looking up. Prices are steadily increasing, demand is high, and buyers are eager to get in on the action. It's like a snowball effect. As more people buy, prices go up, attracting even more buyers. This phase is all about growth and opportunity. Builders are busy constructing new homes and condos, and investors are reaping the rewards of their well-timed purchases. However, it's important to remember that what goes up must come down. The key during expansion is to stay informed and avoid getting caught up in the hype. Keep a cool head, stick to your budget, and don't overpay for properties. Remember, timing is everything. Section 5. Hypersupply. Navigating the peak of the market. Hypersupply. This is the peak of the real estate roller coaster. The market is buzzing with activity, and prices are at their highest. It's a seller's market, and properties are flying off the shelves. But here's the catch. Hypersupply is often a sign that the market is overheating. Like a balloon inflated to its limit, it's only a matter of time before it bursts. Inventory levels may start to exceed demand, and buyers might become more hesitant. This phase can be tricky to navigate. If you're a seller, it's a great time to cash in on your investment, but if you're a buyer, it's important to proceed with caution. Don't get swept up in bidding wars or overpay for a property just because everyone else is. Remember, what goes up must come down. Be prepared for a potential shift in the market. Section 6. Recession. Weathering the storm. Recession. This is the part of the roller coaster ride that nobody enjoys. The market takes a dip, and things slow down. Prices may decline, demand weakens, and buyers retreat to the sidelines. It can be a challenging time for both buyers and sellers. Sellers might have to lower their asking prices to attract buyers, while buyers might be hesitant to invest in a falling market. But remember, every recession eventually ends. And just like the recovery phase, it can present opportunities for savvy investors. If you're a buyer with cash on hand, you might be able to snag a great deal on a property. The key during a recession is to stay calm, do your research, and make informed decisions. Don't let fear dictate your actions. Remember, the real estate market is cyclical, and what goes down will eventually come back up.